Eurozone Madness Continues by Bill Mitchell. In the UK Financial Times article by Daryl Thompson, dollar falls to fresh lows in thin festive trade posted December 24th. The continued slide of the US dollar against the euro is put down to disappointing US economic data, mostly sharp slowdown in new home sales. However, a so-called currency strategist claims it is, quote, deficits rather than the data which are weighing on investors' minds, end quote. The hoary old neoliberal twin deficit attack on public spending is making a comeback. The strategist claims that, quote, the market was already concerned about how the U.S. will tackle its huge double deficits and its commitment to this. The U.S. gives the impression it remains unconcerned with the dollar's fall. Depreciation helps reduce the deficit, end quote. The reality is that the U.S. deficit is currently too small relative to GDP, as evidenced by the rising unemployment in that country. The current account deficit is just a sign that there are foreign interests who wish to accumulate, save in U.S.-denominated financial assets. This is allowing the U.S. economy and consumers to enjoy imports with less exports. A correction will come when the rest of the world desires less saving in U.S. dollar-denominated financial assets. At that point, the gains from the favorable terms of trade will diminish. But this is unrelated to the need for the U.S. government to increase net spending to ensure job creation is sufficient to fully employ their willing labor force. The risk in the U.S. is deflation, following the Japanese route, not inflation. The problem is compounded by the incompetent monetary policy stance of the ECB. They refuse to purchase U.S. dollars in the currency markets for fear of using the U.S. dollar as a support currency, but in doing so, they prevent essential euro liquidity injections into the world economy. The squeeze on their export sector is a result. They should follow the example of the German Bundesbank in the 1970s, which kept their industrial sector competitive on world markets by ensuring they bought U.S. dollars to keep the mark from appreciating. Eurozone countries should abandon the fiscal discipline of the Stability and Growth Pact and increase net government spending, deficits, and further allow the ECB to use all the monetary policy instruments and move away from a singular reliance on interest rate setting to stimulate their economies. However, if the Stability and Growth Pact is going to remain with its destructive fiscal policy implications, then, at the very least, the ECB should be net spending through forex strategies. For the Euro countries, the failure of the ECB to act once again signals the failure of the Brussels-Frankfurt consensus to tackle the chronic unemployment in Europe, which is over 10% in many countries. The European failure to understand the correct macroeconomic policy approach to their low growth, high unemployment malaise is captured by the comments of the Dutch finance minister Gerrit Zalm, who said that the, quote, euro is moving within a range which is still acceptable, end quote. The Financial Times report suggests that, quote, concerted ECB intervention is a long way off, end quote. Zalm went on to say that he, quote, hoped the European Central Bank would increase its key interest rates soon from 2%, end quote, to prevent any inflation from arising as European growth began. Spare the thought that he might become unemployed as a result. Spread the word.